Whenever we think about making an investment, one critical layer of decision making is to ensure really that we are not dealing with a science project. So whatever it is that you're making, will that product be a viable product in a competitive market? And that has to be grounded in really unit economics. And do you understand what are the levers that are influencing those unit economics? My name is Max. I'm very happy to now be building my own firm. We want to be the first institutional backer. And that tends to be the pre-seed stage. It needs to almost feel uncomfortable when you're sitting with them and when they start talking about the thing that they're building. It sits somewhere between urgency, passion, energy, and like just restlessness. And it's intrinsic. You feel it. If you find the rare breed where you have technical depth and this natural, untaught ability to captivate somebody with your words, you're onto something.
This podcast series at the Hack Summit is sponsored by 8, a design agency run by Gabri Grassi, helping impact-driven tech companies reach more people, attract investment, and scale further. Get your free, ready-to-scale brand checklist at the link in the description, together with a playlist of all other Hack Summit resources. If you want to elevate your brand, reach out to Gabri Grassi at the link in the description. Max, welcome to the podcast.
Thank you so much for having me.
Look, I want to talk about building Nucleus as a first-time fund manager. I want to talk about first check investing. I want to talk about science and backing seeds and pre-seed team, so being an early believer. But before all of that, do you mind introducing yourself?
Of course, happy to do so. So my name is Max, and I originally started my journey into entrepreneurship and venture capital extremely early. So actually in my second internship during university, I was lucky enough to become an intern on an investment team of an emerging fund at the time. It was a fund one investing in software as a service companies out of Munich.
Who was that?
It's a fund called Zenovo. They have had a very strict thesis around SaaS companies, and they were early in the space. And so I was very lucky to shadow the partners, learn from them. And funnily enough, thinking back, they were roughly the same age as I am now when we started. And so from that moment onwards, I've always had the spark, so to speak, for entrepreneurship and for building stuff and, moving the world forward. And that then basically has never left. So I spent the last 12 years in the industry, both on the operational side, roughly 5-6 years, and then on the investing side for the remainder. And it's been a hell of a ride, and I'm very happy to now be working, building my own firm and combining both passions. One, investing and the cognitive challenge that comes with it, but also still the entrepreneurial DNA that I've always had in building my own firm.
What is Nucleus today in a few words?
Look, I think there is an aspirational goal for what it's supposed to be. The reality is, it's different things to different people, but the aspirational goal is that we want to be really a very close a fund that is extremely close to their founders. We want to be the first institutional backer. And that tends to be the pre-seed stage. Nowadays, we lead or co-lead those rounds. We're fairly hands-on. This is, of course, dependent on the team. It's hard to generalize, but what we find has worked best is to be an involved partner, really, putting up the sleeves and getting to work. And I think the relationship that we have with our founders is very much grounded in the work. We are not people who like to, talk about ourselves too much or pound the chest and follow narratives, but we like to lead with substance. And this also, it's reflective of the kind of investments we do. And it's also something that is better suited to the kind of founder we back, who tends to be very technical in nature.
We'll go back to that in a second. But, how do you build the belief in very, very early stage teams? Because obviously what you're doing is You take a team that has no product, usually, not even an MVP most of the time, I believe. Mostly just an idea. How do you build conviction there?
Look, I think there's different approaches. But for us, what is working or what has worked in the past is to really, really deeply understand the team composition and the kind of founders that you're backing. It starts with them having identified a pain point in the industry by typically having experienced it themselves, or by having worked in that industry for a very long time and then basically build out a very clear problem and solution fit. So for us, founder market fit is a big topic. Is the team, are the founders the right ones to tackle a particular problem in a particular market? And then the second piece is around, because again, we tend to be investing in rather technical or scientific teams. It's really about, okay, can you, from a scientific point of view, do you understand the de-risking that has to take place in the next 12, 18, 24 months? Can you relate it to the techno-economic realities? So whatever it is that you're making, will that product be a viable product in a competitive market? And that has to be grounded in really unit economics. And do you understand what are the levers that are influencing those unit economics? And typically you can very quickly distinguish whether somebody is chasing an aspirational dream or living in practical market realities. And that gives you a good feeling for whether you're onto something or not. But of course, factors such as resourcefulness, proof of execution, prior startup experience are all considered.
It's interesting because you talk about understanding the science and you don't have a science background yourself. How do you differentiate between crazy science that's never going to work between crazy science that's eventually going to work, right?
I think as a non-scientist, that is probably the most difficult thing. And it is also the one thing that I've seen in practice at other firms and also in the market. Frankly, it is very easy to fool yourself into believing that you think you know what you're doing. Of course, you spend hours and in my case years in a subject matter, and you learn the language, and you can be fluent in a conversation, but you cannot go to a technical level of depth where it would be required. So what I realized very quickly early on is I'm certainly out of my depth, and I need support from people who actually come from the industry. And so a core piece in building the firm, and especially in the early days, has always been to rely on a community that is, made up of people who are domain experts, who come from the field, but who are also not just scientists, but entrepreneurs, because that's an important distinction. Because we're talking about topics where a professor at an academic lab may say, scientifically, we've tried this for 30 years, it will never work. But an entrepreneur who comes with a different mindset, is creative about it, solves problems from first principles instead of addressing them through the literature, through the things that have failed in the past, may unlock something that hasn't worked prior, right? And so you cannot only rely on academic expertise, but you need it in the right context. And so in the very first phase of evolution of Nucleus, I surrounded myself with domain expertise, all of whom had a share in the fund. So I gave them carry, who helped me on technical diligence. Now, as we scaled the firm and as we matured as an investor, we've brought a lot of that expertise in-house. So if you look at the team setup today, I'm the guy that does things like this and goes to conferences. And then I have a team around myself with my co-GP Isabella, who has a background in industrial engineering, Carolina, who has a PhD in biotechnology and bioprocess engineering, and now also with Deni, who is a nuclear physicist. And so I would argue we have a very scientific team. We still have advisors around it. And yes, I remain the the guy that goes to conferences.
Yeah, interesting the way you put it. You were talking about academics being a bit skeptical, I guess, of the science at times. I think in order for you to do your work properly, you actually have to find the topics where academics is almost saying it's never going to work, because if there is a big unlock, then the market unlocks really, and you have a real science innovation, and that story goes a long way. How do you play around with, let's say, science that have evidence already versus science that's completely brand new?
It's a good question. It's an important one. Whenever we think about making an investment, one critical layer of decision making is to ensure really that we are not dealing with a science project. We need to invest in companies that are leveraging pre-existing science to a point where it is commercially viable within 3 to 4 years from our investment. And if we do not have a good understanding that there can be a product that is commercially viable and scalable in the market within a maximum of 4 to maybe 5 years on if we're gracious, then it is likely not for us. Which very quickly equates to, if you look at the TRL, so technological readiness level, it's a well-defined metric, we tend to get involved when it's at least a 4 or higher. Now we have backed companies where it was a 2 or a 3, and let's just put it this way, it's not necessarily something we plan to do in the future, because we do see that given the timelines that we are bound by as a fund typically has a 10-year investment holding period plus extension, so you end up at 12, maybe 13 years. It becomes very hard to commercialize something that is, basically dormant university research at TRL 1 or 2. They don't tend to meet the market realities in time.
Is it something you've learned from the first investments you've done?
Among other things.
What have you learned so far?
I think the lessons are very bountiful. Venture and entrepreneurship, I think, are both they are not they're not jobs, they're vocations in a way, because you need to be mentally ill or insane to do it if you want to do it well. More so as an entrepreneur than as a venture capitalist. I think entrepreneurs have a significantly harder life than funds. Nevertheless, building your own firm, of course, also has a couple of layers of difficulty to it. But essentially, what I've learned is 3 things. One, the job is significantly less glamorous than it looks from the outside, and people have warned me about it. And when I started the firm, I had an idea about how to do the front end, if you will. So, the deal-making side, the sourcing side, the evaluation side, which is good fun. But I had no idea about the back end. So, fund finance, compliance, legal, all of the good stuff. And that's the thing. Like, many emerging managers that started around the same time as I did eventually stopped because they realized, oh shit, there's more to it than just drinking coffee and meeting founders, right? So that's one. 2, I think it is incredibly important as a young investor to make mistakes early, which is it's unavoidable by definition. But it's important to do that in a way where the mistake is not going to break your career. What do I mean by it? We purposefully started by angel investing very early. We built a syndicate. I literally raised money from the soccer pitch. So in Berlin, I have a group that I used at the time. I used to play in for a couple of years as in Rocket Internet entrepreneurs and so on. And they've known me for a while, and they were like, yeah, the guy's competitive. We trust him. He's a nice guy to be around. And then I approached him and be like, they're all founders. And I approached them and I'm like, hey, I'm doing this angel syndicate. Like, do you guys want to, chip in? And so I started fundraising with 2,000 euro checks from friends, fools, and families, quite frankly. And the lesson that taught me is I learned a lot about fundraising, but also I learned that, if you make a mistake on a 10K check, it's not going to break your career, but you learn from the mistake. And so it's important to give yourself room for learning. And we have certainly done a couple of investments that today I would not do anymore. But there's this famous rule of thumb in venture. I don't remember exactly who has coined it, but I think it was somebody at Benchmark or so, or one of the big firms where the partner said it takes about 40 million of learning dollars to make a venture investor a venture investor. And I mean, we're far away from that number, but we've certainly sunk a couple of dollars into the ground. And then the third learning was really it's all about people. It's funny, as an investor, you go through, or I went through different phases. As a junior, I was very much focused on trying to be as analytical as possible, trying to figure out the valuation of a company, making it more science than art, and doing everything about market sizing and all of the good stuff. Then I went back to it's all about the problem and the solution and the innovation of the idea. And now, like 10 years later, I'm at, okay, it's really all about the founder, especially in the early stage. If you have conviction that this is a generational founder, you should back them, because the company will likely pivot 3 or 4 times, and that's okay. And so it doesn't matter if you have done a great market analysis on the first product that eventually the company will not even be selling at that time. So it's really about the people.
I love that you say that, because a lot of the GPs are always saying it's all about people, but they never mention the part where before that they had to go through cycles and cycles of analysis and market assessment and whatnot. Partly because you need to get good at it and to get a good framing of it and how it works, because I think that helps, but also partly because that makes you realize that in the end it's all about entrepreneurs, but you can't only rely on it. I'm sure in your mind you have a filter for wrong ideas and good ideas, so to say, that are directionally correct, that you've just learned through the experience, right?
Yeah, I think venture is a craft where you cannot bypass or shortcut the learning curve. You need to have spoken, you need to have seen to more than 1,000 founders, I think, before your inner compass actually gets good enough to be relevant. And I think the number one thing that I think makes a huge difference in your career as an investor is how early in the journey have you seen what great looks like. And I think I was lucky enough to have had a great training ground, both at Zenovo, some time at HV Capital, but also at Food Labs, where I have seen what great looks like fairly early. And then, lucky enough, I think I've also now identified what great looks like for us at Nucleus, which is, of course, different because it's a different, we're more deep tech, it's different topics. But without that understanding, it can be extremely difficult, because you're basically running and it's repetition after repetition. But if you've never seen what great looks like, it's very hard for you to build conviction.
What does great look like for you now?
This is a good layup. No, look, I think it is a function of a couple of things. Number one, it is a founding team or a solo founder. We don't distinguish. We've backed many solo founders, and I think it's always been a bit of a taboo in venture for some time. And the same goes for solo GPs, by the way. There's many LPs who still today think a solo GP fund is more risk than reward, which I would contradict. And there's ample proof in the data that it works. And the same is true for solo founders. I've found that they execute, the velocity of learning is a lot higher, and the execution of decision making is a lot higher. Anyways, back to the original question. So I think it starts with a team that has, on the first level, an extreme level of energy, an extreme sense of urgency. It needs to almost feel uncomfortable when you're sitting with them and when they start talking about the thing that they're building. It sits somewhere between urgency, passion, energy, and like just restlessness, and it's intrinsic. You feel it. You can feel it's like hot air, right? You can feel it. So that is a baseline. It's like the foundation. And then for us, the next level is, okay, is there one part of the team that is an absolute technical, for the lack of better wording, is like mastermind, which we try to establish by figuring out their level of clarity of thought. So like if you talk about the solution and if you can play it in your head 10 years down the road, and if you know exactly what are the critical levels, how to turn them, how to mitigate it, what will happen if you diverge at a certain piece. So you have a clarity of thought over a long timeline. That is a very good indication. And this is technical. This is technical clarity of thought. And ideally, you have done something in your prior career that is execution related, that speaks to your ability to solve very hard problems in the science in the lab, but also a certain degree of understanding how to scale it. That's two. And the third one is really this ability to captivate an audience or captivate people with a story, with a narrative. Now, there's differences in the ecosystems. The Americans are very good storytellers, but they sometimes lack substance. And in Europe, it tends to be the other way around. But in deep tech, the narrative is extremely important, and the founder's ability to tell a captivating story is one of the key skills, specifically if they are technical by nature.
Yeah.
Which is not always something that every founder has. But if you find the rare breed where you have technical depth and this natural, untaught ability to captivate somebody with your words, you're onto something, because that directly translates to how you sell, how you hire people, and how you raise funds. And those is the three most important skills in the early day.
I wanted to go back to this on scientific founders, because I think they have this particularity, so to say, that they haven't been trained for business. They've been trained to deliver papers, to deliver research. They haven't been trained to convince people. What are some of the mistakes you see them do when they pitch to you, as opposed to what are some of the things that they're doing extremely well? Because to your point, I think I sometimes see pitches where I'm like, I'm sure the science is incredible, but if I don't even understand what it's about, then how are you going to convince other people to work with you, right? So what's your perspective on that?
Yeah, it's a common problem. Let's be very clear. I think it's also a common area where we as a fund make lethal mistakes by passing on teams with a lot of substance for efficiency's sake, right? Like we're a small team, we see thousands of companies a year. We have to be in our filter. In the first 30 minutes, I make a call. That is, do I spend more time or do I dismiss? And we've made countless mistakes precisely based on that.
What's your anti-portfolio looking like?
Look, my anti-portfolios, there's a long list. I wouldn't dare to call it an anti-portfolio just yet, because the jury on whether the company will work is actually still out.
Yeah.
So, with our own fund, we've been doing this for 5 years now. So even the companies that I didn't invest in, they may have raised a good Series B, but that doesn't mean that they will eventually return money. So, there's a couple. There's a company in France called Genomind, which I now find very interesting. At the time, I had trouble, seeing how this will work. There's a company. Difficult to name names, but there's many. Let's say there's a lot. There's Cradle. Which is a big miss. I think Steph is a generational founder. It's not like we didn't see it that way, but this is maybe another lesson. It's like I've passed because of price, so I thought valuation was too rich. The learning that I've had there is, if you're certain that particular founder is a generational founder, the likelihood that they will command a price premium in later rounds is very high. And I think it's probably what happened with Cradle as well. That's been a big miss for us.
I love for you to say that, but on the other side, I'm like, let's please stop all saying that if they are really good, we don't care about price, because then you see, I don't know from your perspective, but today I'm kind of sometimes seeing crazy valuation coming out of famous accelerators, not to name them, for example. And I'm like, yes, you're probably amazing founders, but does it justify, this level, right?
It's a never-ending conversation, I think. It's almost philosophical to a point where I think we all just have to accept that there's always exceptions. And so as a fund manager, I think what's important is to have a level of discipline. But you should still keep the mental flexibility to make that exception if you have high conviction.
Yeah.
So the reality is we try to be on price and ownership target for 80% of the fund. And then there's going to be a bucket where if we feel like this is the one, we'll make a very conscious exception. But I think a big currency as an emerging manager in front of your LPs is doing the thing you promised your LPs you would do. And so in the lack of, if you're lacking a track record and if you're lacking performance in terms of actual cash back to the LPs, which as an emerging manager you by definition lack, then one thing you're being measured on is the team doing what they said they were going to do. And so if you promise your LP an ownership target of X and like 80% of the positions in your fund have Y, it's not a good thing.
Even if successful, do you think? Like even if the fund's super successful?
Yeah, but the problem is you won't know if that is super successful,
Right.
because by the time you raise the next fund, you have maybe 3 or 4 years in.
Fair
And
enough.
so there's, you have from the first year, if you're lucky, you have 1 or 2 breakouts, but they're early breakouts. And then there's a very long tail of the messy
Yeah.
middle. And the messy middle can go sideways, upwards, downwards. Like the reality is you just don't know.
Yeah, no, fair point. Let's go back to what you were saying on, so you've passed on companies because of not wanting to invest enough time, and because I guess my understanding of what you said was the exercise of like looking at the science was too difficult, too long maybe, and you have other things going on, so like you can't do always that. Is that something you still do today? How do you, manage, I guess, when something comes your way? You don't always feel excited at the first call, but sometimes there's a weird feeling of like, I don't want to invest right now, but I need to spend more time. How do you allocate your time?
How do you calibrate is a big question. I think it's a learning curve. It's still something I would say we don't have a perfect formula just yet. But the honest truth, and I like the way that we're having this conversation. I think it's an honest one. That's good. The reality is, if a scientific founder cannot explain what they're doing in very simple terms to someone who is non-scientific, it is a proxy for how a potential customer may react, how potential generalist capital may react. And so this can be a leading indicator, but it can also be a false positive in the sense that we've made mistakes where the founder wasn't able to explain it clearly and in simple words, but then it turned out to be actually a really profound technology. And so that's what I mean. The rate of omission, or like the error of omission on the top of funnel is high, and the cost is severe. And I would say if it's a technology that is truly novel, so I mean N of 1, this is like the first thing in the space, or it's even a new category, I almost always by default take a second or a third call just to like make sure I'm not like missing something. If it's something where we've seen 5-6 companies before and the founder is not capable of explaining a biochemical process in layman's terms, it's not the only thing we look for, but it's one leading indicator, then the chances that we do a second meeting are significantly lower.
Makes a lot of sense. Going back to what you said earlier about being very supportive to your founders and very hands-on, I guess, how do we do that with, I think you have 40 portfolio companies together with the syndicate?
Across 2 funds. Look, I think there's a layer here that I think is for context is helpful. And the very first fund was a very small proof of concept vehicle where we played still an active role, but by definition of our check size, we were a follower. Yeah, so there was always a lead investor on the cap table who had a board seat. We did take board seats. Our mantra at the time, and it still is today, is that we want to be about 10 times as helpful as our check would suggest. So if back then we invested 100K, we wanted to be equally or perceived as equally helpful as the lead investor, which to some extent I think we have managed to do. And today it's still the same. That principle holds true. Today we are the lead investor, but we still want to be 10 times as helpful. So check size to helpfulness ratio is an internal, maybe a vanity metric, but I do feel that it makes a difference. And that's also the feedback we get from founders. So how are we being helpful? Look, I think, and maybe we should have said this at the beginning, but I think it comes back to the fact that we are a sector-focused firm. On the first level of hierarchy, we are investing in the very first round. The second level of hierarchy, it is technical teams, scientific engineers, right? On the third level, it is in domains. So one vertical is food, another vertical is bio, and the third vertical is industrials. The benefit of being a sector-focused firm is that you can build your networks, your support system, and in a way that is tailored to a particular sector. So when you come to us as a food founder, there's a very high chance that we know some of your customers, we know the talent pools, we understand the value chain, we understand the positioning in the value chain, we can give guidance around that. And of course, we know all the food funds who invest after us. And the same is true for bio and for industrial. So you can tailor the support system, or you can productize it in a way that is a better match for the founders. And that I think is also something that differentiates us in the market. So there's the network component. There is also, and this is important, the understanding of how a company in our space gets built, which is fundamentally different from how software as a service companies were built. Where you just can't apply this toolbox or this playbook, right? We're dealing in hardware, in steel, in microbes, it's a very different thing. So what it leads to is, I think we believe we can underwrite the risk profile of such a company because we deeply understand how the dynamic looks like when it's being built. And that leads to the fact that we are investors. If your investors understand the subject matter and they speak the same technical language, they will be less nervous if things take a detour. Or they will be less, let's say, I don't want to say less critical because we are critical, but for the lack of better framing, in certain situations, we already anticipate that a certain route may not necessarily work. And so we're fine if the founder comes back and says, this didn't work. For us, it's more a question of, okay, did we tell you that it won't work and you didn't listen? Or did you tell and you wanted to do it either way, which is fine. Coachability here is important to us, but we won't freak out because we understand that, scaling hardware, scaling bioprocesses is not a straight line. It just isn't. It's more difficult than building software.
Why did you decide to focus specifically on those three verticals? I mean, I think of myself as a specialist investor in climate, but climate is very broad.
Yeah.
You decided to narrow it down to three sectors, to only science teams, do you have the feeling that it's always related to biology to some extent, most of the time?
So I think as a firm, we evolved, for sure. But when we started, the original thesis was that synthetic biology, so, genetically engineering microorganisms to produce other molecules such as proteins with applications in food, but also with applications in industrial contexts like materials. It felt like synbio was a lot broader than food. And so that thesis, I think, has held through. And so the starting point for us was, if you think about a Venn diagram, it was really this Venn diagram of, okay, we have synthetic biology as an enabler, but then the product that is being built could be a food product, or it could be a material, or it could be a green chemical through a bioprocess that decarbonizes the chemicals industry. And so that's where we started. Over time, we did recognize that the principles of building a bio company / any kind of company that has some form of hardware rather than software is in the early stage comparable. The company building dynamic is comparable. And so we branched out a little bit from this like more narrow focus at the intersection of bio-industrial food into, okay, we can be also looking at pure enabling technology in bio. It doesn't have to be a physical product. We can look at more pure play industrials companies where it's like, okay, you may have a chemical process, you may have an electrochemistry process. The matter of the fact is you always need a lab, and you always need equipment, and you always at some point need some capex. And you always raise on the basis of validating data in the beginning, right? Before you have a sellable product. So the dynamic was fairly similar. And so from this, we then also saw that, and I firmly believe that any venture firm is a reflection of the partner's interests at a certain point in time. And so, as I mentioned before, I have this like passion for food, so I've always been doing some food, but I've always loved synthetic biology from a cognitive standpoint. I thought it was a fascinating discipline, a fascinating convergence of science and engineering layered on top with machine learning. To me, was almost a Cambrian explosion of possibilities, and some of that was impact driven. I thought, okay, if we can do things in a more sustainable way, it's a net positive contribution to humanity, and I felt like that was a good North Star to execute against. Today, the reality is maybe slightly different. The green premium is non-existent, but luckily for us, we've always executed investments according to techno-economic realities, and we've never believed in a green premium to start with. So that leads us to be in a good space today, and so we've branched out. We've now covered like manufacturing, robotics, energy, which for us is this new kind of neo-industrial company that's being built, which I think Europe is an amazing place for, because, and also Germany, it's an amazing place full of good engineers. The Mittelstand effectively used to be the neo-industrial backbone of the economy at a certain point in time. I think it's gotten a bit complacent, and we need more innovation, but that's what we fund. And at the same time, we still have investments along the food value chain. We've investments in industrial biotech, and I think we've broadened the scope. But also because our interests have kind of outgrown a certain niche. It's good to start in a niche and then expand. It's the same logic as for a company.
Do you think you'll get tired of food, for example, because you've seen too many pitch decks and startups?
Look, I think one of the most critical skills as an investor is to keep the mental flexibility, underwriting a deal with a fresh pair of eyes, even though you've seen the same thing 5 times and you've seen it fail. And that's incredibly difficult. And that may be the reason that's a disadvantage of a sector-focused fund. Is very difficult to keep an open mind. And so, again, I'm sure I won't grow tired, but I cannot say that I am slightly bored when I see the 10th pitch on the same topic without any kind of novelty. So you naturally build up a little bit of a resistance to certain topics. Yeah, that's true. But I wouldn't say I've grown bored about it. I think it's still all of venture follows hype cycles. Food has had its hype cycle, and we're now in a deep correction phase. But we're also seeing a lot of things that are being deployed. Some companies that are creating serious businesses. It's a different reality from a capital point of view. It's a different reality from where the venture community collectively assumed exit values to be. So you need everybody needed a reality check. It was healthy. And it's what happens in venture all the time.
Yeah. I feel like that's just ongoing consistently. You talked about Europe, but I think you also invest in the US. Is that correct?
Yes.
How do we manage to invest in the US from Germany? And do you are you not afraid? Because one of the things, so we also invest in the US, but sometimes I receive a deck and I'm like, if it's coming to my deck, to my kind of office, right? Why? Like they have so much capital, they have the best funds. Like, like if it's coming to me, it means like everybody passed in them over there in the US. So how do you manage that?
I used to think like that. Now I have changed my mind on the topic. Underlying the statement is the assumption that particularly first-time founders know the venture market, which in most cases they don't. Scientists tend not to have a Rolodex of, who is the top VC in my sector. That is just not true. Second-time entrepreneurs may have that. First-timers typically don't. So I think just by chance that a team ends up on my desk, I have to believe that it's just random because they saw that we're investing in the space and we're, featured somewhere, whatever. So it happens. Obviously, hope is not a strategy, but I think what we're leaning on today is a network of trusted co-investors in the US, which we were lucky to build relationships with over a prolonged period of time, where it is, I think, on their part very clear. There's a very clear understanding of the value that we bring to a company, and so they invite us to invest with them. Which also means in the US we typically do not lead. We take a follower role. And remind you again, this early stage, pre-seed, deep tech, scientific founder is not necessarily something that most Silicon Valley investors touch at this stage. So there aren't as many fold investors as there would be in software. And that is still true today. It's changed. It's gotten more competitive, yes. But I also do feel like, the brand value of a firm compounds over time, and we get a lot of deal flow from founders actively reaching out. But we also have some more experienced founders where they recognize that a lot of their customers are actually in Europe. And the pre-seed and the seed round are the only rounds where I believe a founding team can still diversify their investor base, because at Series A and onwards, the investors need meaningful ownership. And so you cannot build a syndicate. And so we've had the cases where we have second-time entrepreneurs who have had successful fundraising history and potentially even exits. And they purposefully came to looking for follower investors in Europe because they knew they needed access to potentially customers, but also, just to have a hedge, because some European funds do also invest at later stages into American companies, right? And so it's a mix of many, many variables, but I do agree. I would never dare to say it is easy, and I would never dare to say we see every deal in the US. That is just not true.
Yeah.
And one last thing, it's very concentrated, right? We invest in San Francisco, and that's it.
Okay, that's concentration for sure. When we compare the two markets, when we compare Europe and the US, what do you think that Europe has an edge when it comes to science, when it comes to deep tech funders?
I think the quality of science is top notch. The sense and the reality check, so the pragmatism, I think it rates extremely high. And what do I mean by this? Americans have mastered the skill of sales and marketing, and they kind of have it in their DNA almost, where they follow the logic of sell something that you don't have to see if there is demand, and then build it. In Europe, it's different. You build it, and then you see if you can sell it, which I'm not saying is the right approach. But what I mean by this in the context of science is a European founder tends to have a more practical, grounded in economical realities view of their capabilities, which particularly in deep tech goes a very long way, because at the Series A latest, if you are only selling a story and without substance, which unfortunately it does work in venture, the Series A will likely not be raised, because at that point the economic realities are catching up. And so we always prefer to invest in founders where we believe they build along a true economic pathway, and they then need to learn the skill of how to tell the narrative. I mean, there has to be some, I mentioned this in the beginning, there has to be some natural tendencies to be able to tell a good story. But that's still different from, developing a proper narrative around it. And that's something that a founder can learn over time or develop into, but the substance needs to be there. And that, I think, is something that Europe excels in. There's a lot of substance.
A lot of science for sure. That's it's just about taking it out of the lab, I guess.
Yeah.
That's the difficult part.
Which is often more tricky than you may think, especially because there's no uniform tech transfer deal. Every university has their own idea of how things look like. And yeah, I mean, it's one of the fragmentation problems that we have.
Yeah. We can do a full episode on that topic, I believe.
It's not a topic I'm passionate about at all.
among many topics in the capital markets as well, completely being, broken up by different countries. Anyway, not a topic for today. Look, I think, first of all, I think I'll have to let you go because we are recording at Hack Summit, and so there's other stuff going on. But what do we leave people with today? What is the thing that you want people to remember you from?
It's a good question. I've not thought about this. And funnily enough, I've not been asked this before, but I think intuitively I would say whatever it is that you want to do, and this is maybe more a broader life topic, just do it. Don't think too much about it. Just doing it goes such a long way. So when I started, I had 3 acquaintances who were thinking about launching a fund, thinking about launching an angel investment. If I think back, the one thing I just did is like, fuck it, I'll just do it. I put my own money in it and I'll just do it. And that has grown then into something because you learn on the journey. Many people think too much about what could go wrong, what may not work, and they then, for some reason, there's this inherent barrier of like just trying it out. And I think a lot of, naivete plays a big role in any founding journey. And I think that's the one thing, like it's okay to be naive. And it's better to just do rather than think it over too much.
Yeah, I mean, you wouldn't be where you are today if you hadn't started, right? So great advice for sure. Couple of last questions for today. First of all, where do we find you online if we want to reach out to invest in your fund, if we want to reach out to get an investment from your fund, just to co-invest, whatever?
Look, I'm probably more active on LinkedIn and replying to direct inbounds than I should at this point. But I'm very active in replying. And so if it's a genuine request and it's not generically written in a way that it's clear that it's not a fit for us, then I'm very easy to reach on LinkedIn. And funnily enough, our team is based on a principle where we don't have a junior investment team. It's not against juniors. I was a junior myself. I think they're fantastic, but we like, as a philosophy in the firm, we like to differentiate us through the work, and we like founders to work with decision makers. And so this even means that if you submit your pitch deck through our website, it is not a black hole. I myself, as well as the rest of the team, screens the inbound deal flow every fucking week. And so we'll see it. And if it's relevant, we'll reach out. Obviously, we can't reach out to everybody, and we cannot tell everyone that it's not relevant because it's just too much. But we're very responsive if it's something in our hallway.
Fantastic. And now your time to nominate 2 people for an interview to be in your seat, an investor that you admire and a founder that you admire.
So, founder that I admire, I think, is an easy one. Founders, I should say. They're actually siblings. Max and Sarah from Planet A Foods, I think, are fantastic founders on every dimension. So either one or both. You could do one with both. I think it's fun. And investors that I admire. That's a tough one. Because I don't want to bolster anybody's ego, because there's too many who already have a big one. But look, I think someone who's really doing a fantastic job, and who's a frequent co-investors of ours, is actually a fund called First Momentum. Sebastian and Andy have basically built this firm. Well, maybe I'm stretching a bit, but from their dorm room, this is their first real job. They started as students, and they've built it into a really interesting and profoundly well-positioned deep tech hardware company fund. Sorry, we've co-invested with them a couple of times. They're real hustlers. They're engineers by training and investors by choice. That's also a nice framing they have on the website. So I think these guys have done a fantastic job, and they've started even earlier than us, and they were even younger when they set out. And I think they're definitely worth a chat.
Fantastic. Well, thank you so much for your time today. Listeners, if you like this episode and if you like the show, don't forget to like, comment, and subscribe if you're on YouTube, or to give us a follow and a 5-star review on Apple Podcasts and Spotify. Max, thank you so much.
Thank you so much for having me.